Ladies and gentlemen, we're going to get started. Thank you for attending the latest installment of the Option Industry Council's webinar series. My name is Nick Ziegler, a staff member here with the OIC, and I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's session, Trading Credit Spreads and the Iron Condor, we'll take a look at credit spreads, which involve two or more options positions that have the same underlying, as well as the Iron Condor, a specific type of credit spread, and we'll go through it all in a quick 60-minute session. Our instructor today is the OIC's Director of Retail Education, Mr. Joe Burgoyne. Joe has spent more than 3 decades in the financial industry and brings a special understanding of the retail market to the table. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note that there's a box on the right side of your screen where you can submit questions at any point during the presentation. Joe will be responding to those questions during the final 10 or 15 minutes of today's session. Please note that this box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider's support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you, and investors like you, with our future webinars. These survey responses are extremely important to us and will help guide our future programming. As I mentioned, there is a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast, so if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. And now, ladies and gentlemen, Joe Burgoyne will bring you our topic today, Trading Credit Spreads and the Iron Condor. Joe?
Nick, thanks so much, and thanks to everybody for joining us this holiday week. We might as well get right to it. As Nick said, trading credit spreads and Iron Condors. It should be a good presentation. Hey, Nick, talk to me for a second.
Yes, sir. What
Nick?
can I help you with?
Let's see. We got a bad start here.
Not a problem, Joe.
Well, it is from this end.
Tell you what, just let me know when you need to advance slides, and I can make that happen on my end.
Okay, but unfortunately, my apologies, folks. Give me, if you would, this may take a minute or two. It looks like, the laptop that I'm working off of seems to have had a problem here. So what we are going to talk about, obviously, are credit spreads and the Iron Condor. And while this thing is booting back up, a couple things we can talk about for those of you, and I guess most of you are familiar with the OIC, but we've been around actually for 20 years now, doing a combination of live presentations and online education. We have 7 parent companies who help fund us, and we have now a total of 12 exchanges. So that's how we're able to bring both live education and the online events to you month after month. Additionally, and for those of you who have joined us before, you'll know that we've got that industry volume slide that I like to talk about because there's been tremendous volume in the industry over the last 10 years. Average daily volume has gone from somewhere in the neighborhood of a couple 100,000 contracts a day to now where we do between 16 and 17 million contracts a day. And, that's happened for a few reasons. The competition between the various exchanges. I think that the whole time period in that 08-09 financial crisis where people decided to really take their own investment future into their own hands and have gotten more involved with the option space. They've been a few of the things that have helped to drive our volumes. So if you let's see other things. I'll get this presentation up in just a minute, but the credit spread, the whole idea of credit spreads is as we look at our underlyings and look at the market, frankly we have three different choices in terms of our forecast. We can be bullish, bearish, or neutral. And, what the credit spread in Iron Condor tries to do is allow for you, the investor, to get paid while time goes by, basically by taking an option premium in a risk-averse fashion. So that's really what we're trying to do with the credit spread and the Iron Condor. And as I say, I appreciate your patience.
I've gone ahead and shown them I've shown them the volume slide, and I've given them the presentation outline. One other thing that you need to talk about is the disclaimer, the ODD. If you could go over that quickly, so when your computer is ready to go, we'll start right back up into slide 5 or 6.
Okay, yeah, that's a good point, Nick. The ODD is the options disclaimer document, and believe it or not, I mean, that is a 183-page small print document that actually has an incredible amount of information, knowledge in it about options. And not that we're going to quiz you on all the details of the ODD, but essentially what it says is that options aren't for everybody, and we urge you to get a copy of this document either through the OCC or through your brokerage house, before you get involved with the actual use of options. So back to, and thanks for that, Nick. The whole idea of credit spread, as I was suggesting, is this idea of taking in some of the credit that we can create through the combination of spreads in the marketplace. And, it really can be a very effective approach towards increasing our returns, essentially. So I'm working on it here, Nick. And again, my apologies. This is live event. You never quite know with live events, and today we're very live. And I know one of the examples. Let me start by talking about spreads themselves. So I think that many of you are already using options and are familiar with this whole idea of spreads, where we're buying one strike, selling another. On the credit spreads, we're talking vertical spreads. So it is where it's one strike versus another strike. That's how it works, with the credit spread. And we'll typically sell an at the money and buy an out of the money depending on what strike we pick. And it just gets back to our forecast for the underlying actually is very important in terms of what strike we're actually going to sell and what strike we're going to buy. The thing about credit spreads is that they are risk averse, and the key when we're talking any kind of credit spread is that risk aversion. The maximum value for any one of these credit spreads will be the difference between the strike prices, and that's really key. I know in the examples that I'll have up for you in just a minute, the difference between the strikes is going to be $5. And so the maximum that those spreads could be at expiration would be $5. So if we get to sell that thing for, say, somewhere in the neighborhood of $1, $2, or $3, the difference between that credit we take in versus the difference between the strikes is our maximum risk. So Nick, I think we are live. Did we just get that to change
Yes,
for
sir.
you, that slide?
We just moved on over to the disclaimer slide, and I'm seeing us on slide 3. So you are live, and the ball is yours, Joe.
Let me get into a little bit more structure in terms of this, and just I think I'd mentioned before the idea of how many different exchanges. So again, there are 7 parent companies, but a total of 12 exchanges. That's the option volume slide that we talked about, and really, actually, I'm just going to go back to that very briefly, only because you can see, the tremendous increase in the number of options that are traded, and there are lots of reasons for that, but we're averaging, as I mentioned, over 16 to 17 million contracts a day on the various exchanges now. So we'll just pick it up from here with a specific outline for the presentation. We'll just start to talk about vertical spreads already. We'll go through credit spreads, and then both for the call side and the put side, talk about a little bit of the mechanics at expiration, and then hopefully you'll be sticking around for some Q&A. But as I had mentioned before, a spread, now not necessarily a vertical spread, but a spread transaction is where you're going to buy one option or sell another, usually the same underlying, same expiration, and different strike prices. That's what can comprise a spread. But what is critical about the vertical spread is we're talking always same underlying, same expiration, different strike prices. So they're the verticals that we're talking about where we will be creating these credit spreads. Vertical spreads, there are 2 types. We're talking credit spreads today, as you know. The debit spread is a little different because that's the spread where we don't take in money, but we actually pay money to initiate, the multi-leg position. The credit spread, on the other hand, is certainly one where we're going to take money in. So why don't we go, I think teaching works great when we talk specific examples, and oftentimes when we're talking options, the key is what is your outlook on the underlying. So let's take our favorite stock XYZ. We'll say it's trading just under $90 a share at 88.90. Now, our outlook is we think that this underlying XYZ should be lower or maybe unchanged in the next 28 days. Now that's key. Okay, that's our forecast. Over the next month or so, we think the stock may be unchanged to slightly lower. So that being the case, what may we do? Well, if we talk about putting on a credit spread, we have a couple different choices. We could sell shares short, so we go in and sell whatever size of position we want to initiate, and we could just sell them short. Now the key there is we've got unlimited risk, we've got high margin, that's one option, but it's a risky option. Another one is to sell a naked call, also, significant risk, high margins. And then a third choice could be selling this credit spread. So again, back to the forecast. We thought the stock would be, high 80s or lower over the next month or so. So as you know, in options, we've got lots of choices. What strikes, what month, always keys when it comes to options. So with that forecast that we've talked about, we may consider selling a 90 call and then turn around and buying the 95 call. So selling, the 90-95 call spread, and in our example, the net credit's $1.70. I mean, you get the 2 individual prices, but for my, what I like to do is just look at that one net price at $1.70. It allows me to know what my credit is. It allows me to very easily figure out my break even. So in our example, we'll sell the 90-95 call spread for $1.70. With 90 with 28 days to expiration. This is obviously based on our forecast, a bit of a bearish call spread. Let's go through possible maximum profits, maximum reward we talked about earlier. Well, let's start with our maximum risk. How do we go about defining that? Well, we said earlier the difference between the strike prices is how we back into our maximum risk. So in our example, we're short the 90 call, long the 95. Maximum value of that spread at expiration is going to be what? $5. In order for it to be, worth $5 in 28 days, where does the stock have to be? Well, the stock would have to be above $95, right? In order for that 90-95 call spread to be worth $5 at expiration in less than a month, the stock's going to have to be above 95. Now, if we go back to our forecast, where we thought the stock currently at 88.90 would be either in that range or slightly lower. If the stock over the next month runs north of 95, well, clearly, our forecast was dead wrong, so that's going to work against us. So now, when we talk about the maximum gain, what do you think is the maximum gain we can make for this credit spread at $1.70? Well, as is always the case with our credit spreads, the maximum gain is the amount of credit that we take in. So, it's going to be the $1.70. Maximum risk, is it going to be $5? No, it's going to be $5 less the $1.70. So that maximum risk is going to be $3.30. The difference between those two strike prices, $5 less the $1.70 credit we take in. And I talked about, just using that one credit number as the more important number as opposed to knowing what you sold the 90s for and bought the 95s for. I don't really care about that. I'm really just interested in the net credit being 170. And working off that number allows me very simply to know that my break even, as the slide suggests, is going to be that strike price, the lower strike price that we've sold, plus the credit we've taken in. So 90 plus the 170 is going to give us that 9170. That's going to be our break even. So, on the slide we ask, okay, so we know this position is with 28 days to expiration. What's the spread going to be worth, 21 days to expiration? Well, if the stock's still in the 88.90 range, the spread's going to be less than $1.70. We know that. Exactly what it'll be, it's hard to say. With 7 days, it's going to be worth significantly less. But again, depending on where the implied vols are and different things, it's hard to know exactly. But we know as we get closer to expiration, the option with the most value that we have in the position is that 90 call, and that's going to lose far more value over the course of 1 week or 3 weeks than the 95 call. So we know that 170 credit is going to shrink with the stock staying below 90 and especially below that 88.90 level the closer we get to expiration. And I think the next slide just basically, shows us graphically, and it's great if you are able, when you put on different option positions, and this certainly wouldn't be for folks just starting out, but if you, in your mind, can create these P&L graphs, so you know where your break-even points are, I think, it's a pretty good exercise. So that's the call spread side. Again, the stock was 88.90. We had a forecast where we thought the stock would hang out in that range or head south over the 28-day period. Based on that, we sold that 90 call, which was just slightly out of the money, and bought the 95 for $1.70, hoping that we can make that $1.70 with, we know, maximum upside loss potential of $3.30. Let's look at another example, and let's take a look, rather than the call credit spread, let's take a look at the put credit spread. So we've still got XYZ trading at 88.90 per share, but a little different opinion now. We are neutral to moderately bullish, and certainly not bearish below 85. So a couple things we could do here, and this is where, and I give you all a lot of credit for, taking time out of your day to join us today to build your base of knowledge, trying to build that base and get to the point where, not only am I, let's say we're bullish on an underlying, okay, you could go out and buy calls, what have you. There are sometimes far better ways to put on a position than what may seem like the easiest way. So that's where advancing your options knowledge will allow you to maybe put on positions that are a little more risk averse, but may actually give you a better return. And I think that's what things like these credit spreads and Iron Condors may be able to do for you going forward, if they are strategies that suit you. And that's always a very important aspect of this. No one is ever trying to force feed different types of positions on you. You have to be completely comfortable with the types of positions that you employ. So let's take a look at this put credit spread. Again, stock 88.90, and we think we're essentially moderately bullish to neutral in the underlying. So how do we get long? Well, we could buy the 100 shares. We could sell a naked put option. Both of those situations are high margin, high risk. Or we could take the other side and sell a put credit spread, which might be just the right approach. Again, 28 days to expiration. We've got the stock still at 88.90. So right away, what are we thinking? What's the question that I, as an investor and somebody who's trying to initiate a position, what's the first thing I'm asking myself? Well, what strike? What strike am I interested in? And again, that gets back to the forecast. So here with the stock 88.90, we've decided to sell the 85 put and turn around and buy the 80 put. Now, if we were more aggressive, we could obviously sell the 90 put. Now, the 90 put would be in the money by, $1.10 with the stock 88.90. So that would be a far more bullish position. Couple choices. If we were to do the 90, we could sell the 90 put and turn around and buy the 85 put. We could also sell the 90 put and turn around and buy the 80 put. There would certainly be far more risk in that $10 put spread as opposed to the $5 put spread. This put spread is clearly an out-of-the-money put spread. Selling the 85 puts, $3.90 out of the money, and then buying the 80 put. Something I didn't talk about in the call credit spread, but I'll just throw out now, when we're talking about the puts, is this is just a presentation on the concept of the spreads themselves, not so much getting into the Greeks, but know full well that each of these credit spreads does have a delta to the spread. It's one of the great things about spreads. You get to offset some of your Greek risk, whether it's delta risk, whether it's volatility risk. The whole idea of buying one, selling another, or more than that, allows you to hedge some of that Greek risk. So that's just something to consider if you are a credit spread investor. Worthwhile to take a look at the deltas on those various spreads, and that's where for those of you who are maybe a little bit new, it's a great opportunity to go to our position simulator, which is on the website at optionseducation.org, plug in a few credit spreads, and then move that underlying somewhat significantly and check the delta of that spread and see how it equates with the value of those spreads as the stock moves up and down. So that's just that's a little something else you can do in your spare time, of course. In our put credit spread example, we basically, as I said, we're selling the 85 put, buying the 80. We're going to take in $1.35 credit. So if we're selling the 85 and buying the 80, just know full well that this is a bullish put credit spread. Definitely bullish, because we're selling, that option that has more delta when we sell the 85. So let's see. Here we go, Nick. I'm going to need some more help.
Not a problem, Joe. We got slide 17 live for everyone right there.
Yeah, and that
we ready to move to 18?
Not quite yet. Let's bear with me a second. 18 has, let's see. Yeah, bear with me one second, please. Not a good night for the computer, Nick. I apologize, everybody. This is really pretty unacceptable. But
Murphy's Law just before a market close. I think that's what's going on here.
Okay, I'm glad you know. So yeah, try to go to 17 if you would. Once again, I've locked up. So 17.
Slide 17 is live, Joe.
Okay, I wish I could see it, Nick. Yeah, sorry, bear with me. Talk to me quickly about what you're seeing on that slide, Nick.
So that's the put credit spread example with XYZ at 88.90 with 28 days to expiration. You're gonna take them through the maximum gain, maximum risk, the margin, and the break even.
Yeah. Okay. Hold on. I think we're coming back to life here, and okay, it's number 18, right? Okay, let's take a look at that. Let me just set the stage. Okay, so we are short the 85 put, long the 80 put, taking in that 135. So in terms of, you can see on slide 18 where, again, the maximum risk is the $5 less the credit we take in, so the maximum risk. And if you notice in both examples, I go through the risk first, not the gain. I always, as an investor and a trader, I want to know what's the worst case scenario. When I put on a position, I expect, to make money and have a return, but it doesn't obviously always go that way. But to me, most important is to know the risk to the position that I'm putting on. And so in this case, again, the difference between the strikes being 5 less the 135 credit, our maximum risk is going to be the 365. Break even, always important. Can you figure that out, real quickly? And basically, we take that strike price less we're taking our strike less the credit we're taking in to give us that break even at 83.65. So it's the 85 strike minus the $1.35 gives us the break even at 83.65, and we know that below that point, because again, remember, the put credit spread was a bullish position. So we know the forecast is for the stock to hang out or go a little higher, over the next 28 days. So if that stock trades below 83.65 or lower at expiration, we'll have lost money on the position. Slide 19, Nick, just shows, basically how that looks on a P&L chart. No big deal there. And slide 20 really does much of the same thing. Maximum profit is always, with any credit spread, the premium we take in, and the maximum loss is going to be the difference between the strikes. Now on slide 21, this speaks to how to manage, and I really didn't get into managing the call spread, but when you get to expiration, if the underlying is between the strikes, you've definitely got decisions to make. Now, you know your break-even point. You may, be in a position to close out the position for a profit, or maybe you have to close it out and take a loss. But in this particular example, where we're short the 85 put, long the 80 put, if the stock closes below 85, between the strikes, and we do nothing, what's going to happen? Well, we're short that 85 put. We're going to get assigned. And if we get assigned the 85 put, and what does the 80 put do for us? Well, it doesn't do anything for us, because if the stock's between 80 and 85, we're getting assigned on the 85 put. The 80 put is basically going to be out of the money at expiration and worthless. So if we choose to do nothing, we're going to get assigned on the 85 put and be long the underlying, into the trading day, into Monday's trading day. So that's where position management comes into play. Do you want to be long the stock, in our bull put spread position? Do you just want to close out at expiration? That's a decision, that you need to make. Slide 22 just really mentions again this whole idea of maximum loss versus potential profit, difference between the strikes, less the premium taken in. So that's how we get the figure out our break-even points. So that's the call credit spread and the put credit spread. Why don't we just build on that by taking a look at an Iron Condor, and then we'll take some questions. So the Iron Condor is a little different from the call credit spread or the put credit spread. The Iron Condor, is a combination of a couple different spreads. And as I mentioned at the outset, the whole idea of credit spreads is trying to take some of the premium out of the market, based on our underlying opinions. And sometimes, when we talk about the credit spread, we're basically selling premium around a particular range in the underlying. And that's what we do with the credit spread. So on slide 24, we can see exactly kind of how this works. Why would we consider an Iron Condor? Well, again, the stock's still 88.90. We think it's going to trade in a range, getting back to a forecast. Over the next 4 weeks, we're looking at this stock to trade somewhere between 85 and 90. So what are our choices? Talked about earlier, trying to make the best choice from a risk-reward standpoint. A couple different choices. We could sell out of the money call, sell naked out of the money put. That's one approach. Lots of risk, lots of margin, and of course you need different levels of approval from your broker for something like that. Another approach could be to sell this Iron Condor spread. So let's get into this and see exactly what that is. Condor is a sale of a call credit spread and the put credit spread. So we're doing both at the same time around our particular forecast. Of course, it has to be the same underlying, same expiration. Both spreads are out of the money spreads, and that's how we're basically trying in a risk-averse fashion to take in premium out of the market. So 28 days to expiration. Again, the all-important forecast, expected price range is between that $88, $85, and $90. So we know what we did with the call spread. We sold that 90-95 call spread for $1.70. And it makes sense that, and we turned around and sold the 85-80 put spread and did that for $1.35. It makes sense that the call spread is going to be worth more, certainly because we think about it, the midpoint is going to be that 87.50 range, but we're well above that at 88.90, so you could expect to take in more for the call spread than you would in the put spread. But you take in those two credits, and what do we have? We've got $3.05, and we've got what is called this Iron Condor. So let's think about maximum risk. What is our maximum risk? Well, maximum risk we've talked about a few times. That's going to be the difference between the strikes. Maximum gain. It's going to be that credit that we take in. In this example, we're taking in 2 credits for a total of 305. That's what our margin, so our maximum risk will be the 305 plus the difference to get us to that $5 difference between the strikes. So that's going to be the 195 maximum risk with a margin of 105. Break even is going to be, those strikes plus or minus the credit we've taken in. So on the upside, it's going to be 90 plus the 305 with a 93.05 break-even point. And on the downside, it's going to be that 85 strike minus the credit we took in, takes us down to 81.95. So that's the Condor. And this next slide, slide 29, I think shows that quite well. You can see that our break-even line, we've got quite a significant range between, let's say, 82 and 93, where we make money. And, again, going back to the position simulator that we offer on the website, you can go in, look at, some of your favorite underlyings and see what kind of credit you can create by selling these out-of-the-money call spreads and out-of-the-money put spreads. And really, that's all that an Iron Condor is. It's selling an out-of-the-money call spread and an out-of-the-money put spread around your forecast and the underlying. So slide 30, Nick, just a couple other considerations. We get into the Condor or any spread for that matter. Obviously, there are going to be more commissions because there are more options that are being traded. You do want to be aware of your margin. You do, when the stock is between the strikes at expiration, you do have a proactive management decision to make. Do I want to close out the position for my profit or loss? Do I want, am I going to allow myself to be assigned if that's the case and either be long or short stock? So that's something that you have to be very mindful of. So just to wrap it up, Nick, before we go to questions, characteristics of spreads, they are lower costs, certainly, than selling short naked options, and most importantly, they have significantly less risk. At the same time, there is limited profit potential, but these are positions that are very quantifiable in terms of their risk-reward profile. So with that, Nick, just for those of you who may be new to OIC, great resource there on slide 32, 888 options. We've got 6 experts down in either Texas or out in Chicago there every day of the week to take any call you may have on options. Please do call them anytime you have a question, and of course there's the address to our website. So with that, Nick, and a bumpy road for sure, and my apologies to everyone for that. Never know what's going to happen. I certainly didn't expect that, but why don't we roll to some questions?
Absolutely, Joe. One of the things that I saw come across the wire more than a few times was the concept of margin. Can you just go into a few sentence explanation of what you mean in some of these slides when you're talking about margin computations?
Okay, and thanks for the question. The margin is going to be the amount of money that the brokerage house demands that you put up. So oftentimes it's going to be, there are different computations depending on which type of spread or type of position, either in a stock position or underlying position, but the margin basically equates to the amount of money that you need in your account to be able to put on the particular position. One more thing I might add is, as you get into different multi-leg strategies, the brokers oftentimes have different levels of approvals. So be sure that you know what those different levels are, and it just gets back to having a good relationship with your broker.
Joe, this is a question that just rolled in. I thought it's very timely considering we just talked about the Iron Condor. This attendee wanted to know, is it true that you can't lose on an Iron Condor because you can't lose both legs?
Well, I wish I wish I could talk to that person who asked that question point blank. Now, you can't lose. Now, let's go back to the whole idea of risk. And of course you can lose. I mean, the only way you couldn't lose, in our example, let's see, the difference between the strikes was $5, is if somehow you took in a $5 credit. Okay, but if you're taking in a $5 credit, then the options are going to be, some of the options are going to be in the money, and you have a chance of assignment. And so the whole idea of, almost any position, Nick, where, you can't lose is a very, very, very unusual situation. Certainly not the case with the Iron Condor. What the Iron Condor is doing, and again, it is rather than through one credit spread, it's trying to take advantage of the use of two credit spreads to take premium out of the market. But you certainly can lose because neither one, again, we're talking about out of the money call spreads and put spreads. So if they're out of the money, they are going to be worth something less than the difference between the strikes. And so whatever the difference between the strikes, less the credits they take in, whatever that difference is, that's where you have, the potential for loss. But the great thing about the credit spreads, and I think this is why we chose the topic tonight, Nick, these are real manageable positions. If you understand, the core concepts of options, the whole idea of, being assigned where you have to fulfill an obligation to either be short stock or to acquire stock, versus exercising where you have the right to do either, you get both of those concepts happening here in the credit spreads. And so there's very, very manageable risk. You know what your risk is going in. It's quantifiable. You may have the need to manage and make a decision on these spreads at expiration because, again, we're selling an out-of-the-money call spread, an out-of-the-money put spread in the Iron Condor. Those spreads may not be out of the money, when expiration comes. So at that point, you have to decide, what do I do? And back to the question, there certainly is risk, and I think, that gentleman or woman just needs to probably step back a little bit more and look at the two credit spreads that go into making up the Condor and trying to understand like our one slide, I'll go back to slide 29, the whole idea of where we make money in the credit spreads, both the put and the call. And in our one example here, we almost between 82 and 93, we were apt to make money right up until expiration. So that's a long answer, Nick, but I think there's a lot to talk about when we talk about positions with no risk.
Absolutely. And Joe, I'm glad you made that point about manageable positions because we had a lot of questions that came about really the nuts and bolts of how to get these positions moving. And this investor wanted to know if you believe credit spreads are the best or at least among the best vehicles to use for somebody to augment income by having minimal risk. Would you say credit spreads out of the pantheon of option strategies that would you recommend credit spreads for that?
I would, Nick, and I am a big believer in both credit spreads and the Iron Condors. But to me, most important is you have to have a pretty good sense of the underlying. So you don't want to just put these spreads on in underlyings that you're not comfortable with, have a fairly strong forecast about. We're not just throwing darts here to try to, take in some money. The whole idea is, we've got some expertise in the underlying. All option strategies and positions start with the underlying. So when you are comfortable with, however many underlyings you trade and are comfortable with, around those different underlyings, I think the credit spread and Iron Condors are wonderful strategies for enhancing income.
Well, piggybacking off that question, would you say that debit spreads have a lower risk than credit spreads?
Well, for every credit spread, there's a debit spread. And, so they're, it's exactly the opposite, because if we're taking in $1.35, the difference between the spread is going to be the difference between the $1.35 and the $5. So again, the credit spreads gets back to there is a reciprocal relationship between the two, but I think generally this idea of enhancing income through credit spreads makes the most sense.
Let's get back to this idea of really putting the rubber to the road. How would you go about correcting a bull put spread that has suddenly turned against you? What would you do to correct that?
A bull put spread that has turned against us. So that could be, in our example, where we were short the 85 put and long the 80 put. Let's go back to that. So where we were looking for the stock to, certainly stay above 85 at expiration, I think this gets back to, and we didn't really talk about this I guess at all throughout the presentation, the whole idea of what is your approach to managing risk. I mean, I'm a big believer you don't put on option positions and then marry them to expiration. Markets and underlyings change all the time. The whole idea of trying to manage risk is the idea of being fluid and on top of things. It's not to say you want to micromanage and overtrade, but I think with our forecast in this particular stock, where we thought it was going to hang out in the high 80s, it's a great discipline. I'm not going to say that I use or used it all the time, all those years on the floor, Nick, but it's a great discipline to know when you put on any position, when you will get out or cut your loss. I mean, I think actually not that many investors have that strong a discipline, but almost putting in a stop order when you initiate your position based on, well, I'll stop myself out because bottom line, my forecast was wrong. And so the whole idea of, and in our example, selling the 85 and buying the 80 put, we sell that thing for $1.35. Maybe if that spread goes to $2, or maybe if the underlying goes to a certain point. And again, for the third time, I'll mention the position simulator. Use that free tool that's on the website to see, I mentioned the delta in spreads. See how far you have to be wrong for that, credit spread to get to the point where, you certainly didn't sell it at $1.35 to have it go out at $5 and lose $3.65. I don't think anybody's got that in mind. So the question is, where do I cut my loss? And for each of us on the presentation tonight, we all probably have a different opinion. But I would urge investors to at least try to know either where you're going to get out based on the value of that spread, and also where the underlying has to go to create that price in the spread. Essentially, Nick, that's working both sides of any trade. Getting in can oftentimes be the easiest part, and many folks, get into a position and don't think about getting out if they're wrong. There's more work there, but if you do that work up front, it's a far easier decision to make.
Thanks, Joe. And ladies and gentlemen, just to clarify, Joe's been referencing the position simulator, and that's available at optionseducation.org. It's one of the free tools we have on our website. You can go ahead and mock up any position that you might want to try and see what would happen as different stock prices and different positions come into play. Joe, another question we had come up multiple times was the question of volatility. Can you just talk about volatility in general as it pertains to credit spreads?
Sure. Now, and when we talk volatility, we're talking in the option space, we're talking implied volatility. So let's get back to these common sense ideas about options. The higher the implied volatility, meaning the greater the expectation for the underlying to move in the future, the higher that implied volatility is, the higher the option premiums are. So if we get back to, option fundamentals, and we're talking about selling credit spreads. So we know that we're going to sell either a call or a put in that spread with more delta than the out of the money. It's going to be closer to being at the money. So there's going to be more time premium in those options, in the options closer to the at the money strike than the out of the monies. So generally speaking, as implied volatilities increase, the value of these credit spreads will also increase. It's going to depend where the underlying is, and as the implied volatilities decrease, the credits you're going to be able to take in are going to be less. And let's get back to, again, what's implied volatility? Implied volatility is the market's expectation for the amount of movement in that underlying in the future. So the greater the expectation, the higher the premiums, the lower the expectations, the smaller the credit. It's that simple, Nick, but that gets back to real fundamental option concepts.
Great, Joe. Another set of questions that we've had from a number of attendees is about risk, specifically as it pertains to the Iron Condor. Can you review how risk should play into your decision when you're employing an Iron Condor strategy?
Sure. There's just really one key difference between the Iron Condor and the call credit spread or the put credit spread. And, with the call credit spread and the put credit spread, we're really playing one side of the market. If we sell the call spread, we're looking for the stock to, hang out or go south. And the opposite is true by selling the put spread. What we're doing with the Condor is really trying to take in a credit from both sides of where the stock currently is. And in terms of, looking at the risk is still the difference between the strikes. And then you just, add or subtract the credit that we're taking into those strikes that we're short that are closest to the stock price. So the key difference is, with the vertical spreads themselves, we're just playing one side, either, the upside or the downside, where with the Condor, we're playing both the up and the downside. But again, the risk is defined in advance, and that's the difference between the strikes. In our examples today, Nick, we talked about $5 differentials, in our strikes. But, it's not uncommon for investors to do wider strikes than, consecutive strikes. They can spread that out to $10 increments and, even larger in some cases. But, don't forget to take a look at the delta of those spreads as well.
Great, Joe. We got a question in that I think the answer is going to be one of your famous "it depends" scenarios, but this investor wanted to know about the percentage loss that would be tolerable when using a credit spread. Would you take a 25% loss before you look at a different position, a 50% loss? Basically, what would you do in that given situation?
You nailed it, Nick. It definitely depends. There are a number of different factors, though, and oftentimes, as investors, we have far more than one position, and sometimes we allow one position that's going good or bad to affect our other decisions. So I completely endorse the decision or the answer that it does depend. It depends on you, the investor. What is your risk tolerance? Why did you get into this position? You sold that put spread for $1.35. Did you sell that for $1.35 because you think, over the course of 7 days you can make, $25 and then get out? Or did you sell it for $1.35 because you're going to wait 28 days with the expectation that you're going to make the $1.35? So, it's impossible to answer that question. It gets back to, obviously we're all putting on positions to make money, but is the goal to take in the entire credit? Is the goal to just take a little fade out of the market and cover it in a week? So, just to repeat your correct answer, Nick, unfortunately, it does depend.
As with many things in this business, that's often the case. Joe, a lot of the questions that we're also seeing pertain to the Greeks. I think these are coming from some more of our sophisticated investors, and the one that keeps popping up in these questions is about Delta specifically. Is Delta the only Greek we should be concerned with when we're looking at credit spreads? Talk a little bit about the Greeks in general, but tell us mostly about the Delta as it pertains to these credit spreads.
Okay, well, we've got the 5 Greeks. We've got Delta, Theta, Gamma, Vega, and Rho. We've already talked about a couple of them. Delta is just going to give you a good idea, so look at the delta of that spread and you'll see how much you can expect the value of that spread to change with every 1 point move in the underlying. So keep an eye on the delta. We already discussed Vega because, as implied volatilities go up, credits, options are worth more, so we're going to take more money out of these credit spreads. Theta is the reason, frankly, that we're putting on these spreads. We're trying to, take something out of the market based on our underlying, and theta is going to drive that. Rho is, really pretty insignificant. It's really insignificant to the equation, and Rho being the interest rate Greek, and then that's really I think we've covered them.
Talk a little bit more about Delta specifically. Some people have asked, how do we calculate it? How important is it? Could you go into a little bit more depth on that?
Okay. How do we calculate it? The good old pricing models do that for us, and on our platform, obviously each option is going to have its own delta. So just net the difference between the one you're short and the one you're long, and that's going to be the delta you have on the spread. And of course, that delta is going to imply how much the value of that spread should change as the stock moves up or down. Getting back to our position simulator, look how these deltas change as the stock gets closer to expiration and also closer to that short strike. That's where, the management of these positions comes into play, and that's where knowing your break-even points, knowing where, you're going to close out for a profit or, close out for a loss, gets awful important. So the delta in these spreads, especially as we get close to the strike and close to expiration, becomes very important.
Joe, another question we had is about protecting the positions, especially as it pertains to the Iron Condor. Do you have any general strategies for our investors to help protect an Iron Condor position?
Well, I think it really, Nick, in terms of protection, we've already, I think the question is more about, when do I take my lumps and get out? Because, the beauty of what we're talking about today, we have protection. We've got limited loss. And that's why I think these strategies have become, so widely used. In terms of, I'm really looking at this question as one that says, when do I cut my losses and get out? And, to me, the most important thing is just know that credit that you put this thing on for. Go back to your underlying chart, and, this is how I manage these things. When I have an underlying, I've got a forecast and it goes against me, I know in my mind, what the price of the underlying is and what, in a pretty close proximity, what the value of the spread's going to be at that point, and I take my losses and move on. And oftentimes that's the best trade to when your forecast goes bad, you take your loss, you move on to the next thing, and that allows you oftentimes to trade far better because you got a clear head.
Great, Joe. We are just over our 60-minute time, but we'll take one more question that we have, and I think this will be a good one to close it out with. We spent all day talking about credit spreads. We spent all day talking about the Iron Condor. In what scenarios would you look to do a spread, or what scenarios would you do just a simple call or a put? Tell us about why we should use these, Joe.
Okay. Simple calls and puts. I mean, I guess we're talking about getting long, getting short. I am much more of a spread trader than I am just long calls or long puts. Much prefer spreads because of the managed risk aspect. If I am going to consider just long calls or long puts, a big part of that equation has to be the implied volatility level of those options. And it's not rocket science. Again, Nick, on our website, we've got under tools and resources, we've got the historic and implied volatility charts. To me, those things are gold. They tell you how much the implieds move over the course of the last year. So if I am going to get in there and consider just buying calls or buying puts, that implied volatility has to be on the lower half of the range over the last year. And, that's the approach I take. But, getting back to what do I prefer? Personally, I prefer the idea of spreads versus straight calls or straight puts.
Great, Joe. Thanks so much. Do you have any closing remarks for our attendees today?
Only really to thank them. I hope many or all of you hung in, and apologize for the ridiculous technical difficulties, but Nick and I really do enjoy offering these presentations, and as you saw last time, we will be having guest presenters from time to time, so just please keep joining us. Tell your friends, and as Nick pointed out early, if you could take 30 seconds to fill out those couple questions on the survey, we take them very seriously. So thanks. That's it, Nick.
Ladies and gentlemen, thank you so much for attending. We do appreciate your time just before a market holiday and during a holiday week. To reiterate, the position simulator that Joe and I reference is available under the Tools and Resources dropdown on the optionseducation.org website. Feel free to check that out at any time. And, of course, our investor services team is available to help during normal business hours. Give them a call anytime at 1-888-OPTIONS. While we weren't able to get to all of your questions today, they'll be available to help you out if you want to talk about options, if you want to talk about positions, if you want to talk about strategies. They'll be able to give you some advice, and hopefully they can put you on the right path to helping your trades. We'll be holding our next webinar during the first week of May, so please check our optionseducation.org website in the upcoming weeks, or keep an eye in your email for details about that session. These webinars are archived for later viewing. They will be available through On24's on-demand portal, and they'll also be available within the next few weeks on the OIC's YouTube channel. Ladies and gentlemen, thank you so much for your time. We hope you enjoyed yourself and learned something, and we'll hope to see you at our next webinar.